Ever wondered why the price of silver remains constant and does not increase, even in the face of global monetary changes? This question, seemingly simple, has perplexed many for decades. It's a puzzle that often leaves economists scratching their heads, and it's about time we unraveled this mystery. Silver, a precious metal that has been valued for its luster and malleability since the dawn of civilization, has a value that seems to stand the test of time. Unlike other commodities that fluctuate wildly with market trends and economic shifts, the price of silver remains remarkably steady. But why is this? The answer lies in the intricate web of economic principles, market dynamics, and the very nature of silver itself. You see, silver isn't just a shiny metal that we use to make jewelry or coins. It's a crucial component in various industries, from electronics to medicine and even green energy. The increasing demand for these sectors means that the supply of silver is always in demand, yet the price doesn't skyrocket. It doesn't follow the typical supply-demand curve we learn in economics. Instead, it stays constant. This constancy, while puzzling at first glance, is a testament to silver's enduring value. It's a reminder that silver is more than just a commodity. It's a stable store of value, a hedge against inflation, and a symbol of lasting wealth. Understanding the constant price of silver isn't just about satisfying curiosity. It's about gaining a deeper comprehension of the global economy, of the forces that shape our financial world. It's about recognizing the role of precious metals in our society and their potential impact on our future. This mystery of the constant silver price is more than just an economic conundrum. It's a fascinating exploration of value, of wealth, and of the complex dance between supply and demand. It's a journey into the heart of our monetary system, revealing insights that can transform the way we view the world. To unlock this mystery, let's dive into an insightful story. Imagine this. Robert, an experienced investor, shows Peter, a curious economist, a $50 coin from 1964. This coin, bearing the likeness of President John Kennedy, is not just a piece of history. It tells a tale of value, worth, and the shifting sands of monetary principles. The coin, once composed of silver, now reveals signs of copper, yet today it's valued at $12. Robert begins to unravel the story behind this change, introducing a key player in this tale, the Gresham Act, named after Sir Thomas Gresham. This act, which plays a significant role in economics, epitomizes a monetary principle that bad money drives out good money. To put it in simpler terms, if two forms of commodity money are in circulation, each recognized by law as having the same face value, the one with higher intrinsic value will gradually disappear from circulation. Under this law, good money is defined as money that shows a small difference between its face value and its value as a commodity, like the value of the metal the coin is made of, often precious metals such as silver or gold. Contrastingly, bad money is money where the commodity value is significantly lower than its face value. This bad money circulates alongside the good money, both forms being accepted at the same value as legal tender. Robert shares a personal anecdote from his past. In Hawaii, he used to exchange the dollars he earned as a caddy on golf courses for silver coins at the bank, having recognized that the paper was, in his words, fake money. As we stand in 2024, the United States is the world's largest debtor, a consequence of Gresham's law. The country allowed money to be printed in excess, leading to a world brimming with counterfeit US dollars. Robert's understanding of the Gresham Act and its implications shaped his approach to money. But how does this relate to the constant price of silver? Gresham's law states that bad money drives out good, but what does that mean for silver? Let's navigate the choppy waters of economic theory to understand this. Gresham's law, named after Sir Thomas Gresham, is a monetary principle asserting that bad money drives out good. Imagine we have two forms of money in circulation, both of which are accepted as having the same face value by law. According to Gresham's law, the money with the higher intrinsic value will gradually vanish from circulation. This brings us to the definitions of good money and bad money. Good money, in this context, is the money where the difference between its face value and its value as a commodity is negligible. The value of the commodity in this case refers to the value of the metal the coin is made of, typically precious metals like gold and silver. Contrarily, bad money is the money where the commodity value significantly trails behind the face value. This form of money circulates alongside good money, and both forms are recognized at the same value as legal tender. So how does this tie into silver? Well, silver coins were once good money, their face value closely aligned with their commodity value. However, with the introduction of cheaper alternatives for coinage, they found themselves pushed out of circulation. Why use a silver dollar when a nickel-plated coin is accepted at the same face value, right? The introduction of these bad money alternatives led to a hoarding of silver coins, effectively driving them out of regular circulation. This, in turn, put a lid on the price of silver, keeping it relatively constant despite the increasing demand in various industries. In essence, Gresham's law inadvertently played a significant role in the constant price of silver. It helped maintain a steady price by driving silver coins, once a common form of good money, out of regular circulation. The Gresham Act plays a significant role in the constant price of silver, but there's more to the story. The USA, the largest debtor in the world in 2024, is a direct result of the implementation of Gresham's law. A bold claim, isn't it? But to understand this, let's delve into the aftermath of Gresham's law. When the administration violated Gresham's law, it led to a floodgate opening that changed the course of monetary history. The law, named after Sir Thomas Gresham, is a fundamental principle in economics stating that bad money drives out good money. Now, you might wonder, what does this mean? Well, imagine you have two forms of money in circulation, both accepted by law as having the same face value. The one with the higher intrinsic value, often referred to as good money, will slowly disappear from circulation. Why? Because people, being rational beings, tend to hoard the good money and spend the bad money instead. This is exactly what happened when the administration allowed money to be printed. The market was flooded with bad money, paper currency, whose value as a commodity was significantly lower than its nominal value. The good money, gold and silver coins which held value in their metal, started disappearing from circulation. This, in turn, led to an imbalance in the economy, pushing the USA towards becoming the largest debtor in the world. The world today is awash with counterfeit US dollars, a direct consequence of Gresham's law. The real danger lies in the fact that gold and silver, the good money, are being replaced with collateral bonds. These bonds, unlike gold and silver, are not tangible assets and hold no intrinsic value. So, what does this mean for an average Joe? Well, it means that the money in your wallet is losing its value day by day. Your savings are not as safe as you might think, and the worst part? The repercussions of this law are not limited to just the USA, they have far-reaching global implications. The implications of Gresham's law are far-reaching, but what does this mean for the future of silver? Well, that's a question for our next scene. Stay tuned. So we've journeyed through the past and present of silver, but what does its future hold? As we look towards the horizon, it's imperative to remember that silver plays a dual role as both an industrial and precious metal. This dual persona is a defining characteristic of silver's identity, and it significantly influences its market dynamics. Let's start by considering silver as an industrial metal. As we transition into a more sustainable future, the demand for silver is set to skyrocket. From solar panels and electric vehicles to electronics and medicine, silver's versatility makes it an indispensable asset in various sectors. With the world's silver inventory struggling to keep pace, it's only logical to expect an upward pressure on its price. But that's not all. Silver's status as a precious metal also plays a crucial part in its future. Traditionally, precious metals like silver have served as a safe haven during economic uncertainty. With the world economy being as unpredictable as it is, the demand for silver as a precious metal is unlikely to dwindle. In fact, it could even increase, further driving up its value. However, despite these compelling factors, the price of silver remains relatively constant. This apparent paradox leaves many scratching their heads. But remember, markets are complex ecosystems influenced by a myriad of factors, some visible, others not so much. While we've explored some major influences, there are many other variables at play, each contributing to the intricate tapestry of silver's market dynamics. So, what's the takeaway from all this? Well, the potential for silver to increase in value is certainly there. But whether or not it will, and when it might, is something that no one can predict with absolute certainty. As with any investment, it's always crucial to do your research, stay informed, and make decisions based on your individual circumstances and risk tolerance. The story of silver is an ongoing saga. Understanding its past and present helps us anticipate its future, making us wiser investors and economists.